We will be getting underway in just a moment. Thank you. Good morning. Thank you for joining us for the Economic Outlook presentation. It'll be in two parts today. You'll hear first from OECD Secretary General Mathias Cormann, followed by OECD Chief Economist Stefano Scarpetta. For those in the room and watching online, please be aware there is simultaneous interpretation, French and Spanish from the English. With that, we'll hand it over to the Secretary General.
Good morning, everyone, and warm welcome to the launch of this OECD Economic Outlook. The title of our Outlook today is Under Pressure. That is not a rhetorical flourish, it is precisely where the global economy is at. For 5 years, the world economy showed remarkable resilience, absorbing a pandemic, an energy shock, and the fastest interest rate tightening in a generation. Global growth reached 3.4% last year. The technology sector was booming, AI-related investment was providing real momentum. And then in late February, the conflict in the Middle East escalated sharply. The Strait of Hormuz was effectively closed and has been ever since. And the consequences are now flowing through every corner of the global economy. The Gulf region is far more than an energy supplier. I mean, this slide illustrates the breadth of the exposure. Prior to the conflict, Gulf countries accounted for 26% of global oil supply and 31% of all liquefied natural gas. Global oil supply has since fallen by 13.5%. Gulf oil production is down 45%, but the disruption extends well beyond energy. Qatar alone accounts for around 35% of global helium exports. Helium being a critical input for semiconductor manufacturing, which is now under acute pressure, precisely at the moment when demand is surging from AI and digital infrastructure investment. That is, the upside and the downside risk are directly connected. The energy supply shock has produced sharp increases across the board. Brent crude rose to $118 US per barrel in late April, its highest level since 2022. It has remained above $90 for nearly 3 months. Diesel and jet fuel prices are around 50% higher than before the conflict, pushing up transport, aviation, and freight costs across the global economy. But the surge in commodity prices extends well beyond energy. Prices have risen by up to 55% for a range of non-energy commodities, highlighted on this slide. That means higher costs for fertilizers, digital technologies, automotive components, and chemicals. Inflation, which had been on a clear downward path, has turned. Since February, price pressures have risen in the United States, the Euro area, South Africa, Brazil, and India. Government support measures, price caps, subsidies, tax reductions have contained some of the increase. Without them, the picture would be worse, and of course the impact will not fall evenly. Around 1/3 of OECD economies are projected to experience negative real wage growth this year. Workers in these countries will see their living standards fall, which is the human reality behind the inflation numbers in front of us. There's an important countervailing force in this picture. The technology sector, and in particular investment driven by AI, has been a significant engine of growth. Industrial production of computer and electronic products is substantially outpacing total industrial production. But as the helium and semiconductor point illustrates, this positive force is not insulated from the energy shock. Before turning to our projections, one important piece of context on trade policy. The effective tariff rate on United States merchandise imports was around 10% in April this year, down from around 18% a year earlier. This reduction has been positive for trade and growth and is one reason underlying momentum was stronger than expected before the conflict escalated. However, uncertainty remains high. The 10 percentage point tariff introduced by the United States following the Supreme Court's ruling on the International Emergency Economic Powers Act is due to expire in late July unless Congress extends it. How that is ultimately resolved will matter for the outlook. Our central projection, the relatively more time-limited disruption scenario, assumes energy prices evolve broadly in line with futures markets as of 26 May, with oil averaging $92 US per barrel this year and $80 next year. We project global growth of 2.8% this year and 3.1% next year compared to 3.4% last year. That is 0.4 percentage points lower for 2026 than we projected in February before the conflict escalated. On inflation, average G20 headline inflation is projected to rise from 3.4% last year to 4% this year, or 0.9 percentage points higher than our February forecast, before easing to 3.1% in 2027. In the United States, stronger energy sector exports will partly offset lower household purchasing power. GDP growth is projected to slow from 2.1% last year to 2% this year and 1.8% next year. In the euro area, growth is expected to ease from 1.4% in 2025 to 0.8% this year before recovering to 1.2% next year. Labour market resilience and next-generation EU spending will partly offset tighter fiscal policy in France, Italy, and elsewhere. Japan is among the economies most exposed to this conflict through energy imports and supply chains. Growth is projected to fall from 1.1% in 2025 to 0.6% this year, recovering to 0.8% in 2027. Domestic demand, supported by robust wage growth and energy subsidies, will provide some cushion. In China, growth is projected to ease from 5% last year to 4.5% this year and 4.3% in 2027, with high energy import dependence and falling real estate investment the primary drags. This outlook is surrounded by significant uncertainty, and the risks are predominantly to the downside. To illustrate the downside, we have developed a prolonged disruption scenario in which energy prices remain 50% higher than futures market prices imply from the third quarter of 2026 through to the third quarter of 2027. Under this scenario, oil prices will average $115 US per barrel this year and $119 next year. Global growth would fall to 2.1% this year and 1.8% next year. G20 inflation would increase to 4.4% in both years, and prolonged high energy prices and input shortages would also pose a particular risk to this technology sector and AI. Energy accounts for around 60% of data center operating costs, meaning a sustained shock would undermine the very growth driver that has been partly offsetting the disruption. The near closure of the Strait of Hormuz is squeezing fertilizer markets. Fertilizer prices have risen close to their 2022 peaks. Our estimates suggest that a sustained 47% increase in fertilizer prices, which reflects current market conditions, would raise agricultural commodity prices by around 8% next year. Wheat prices could rise by 13%. And this is not an abstract risk. It is a very real food security risk, and it will fall hardest on the most vulnerable economies and the most vulnerable households within them. Financial risks are also rising. Since late February, sovereign bond yields have increased across most economies, with pressure more pronounced at shorter maturities. That means governments are facing more immediate financing cost increases. This limits the fiscal space available to respond to the shock. In terms of policy priorities, the most important single thing that can be done to ease pressure on the global economy right now is to re-establish secure trade routes through the Middle East and protect energy infrastructure. As long as the disruption continues, every other policy response is managing consequences rather than addressing causes. On monetary policy, central banks in the major advanced economies have kept policy rates unchanged so far this year. If the energy shock remains contained and inflation expectations stay anchored, the rise in inflation may prove temporary and may not require a policy response. But if broader and more persistent price pressure emerge, adjustments will be needed, and of course central banks will need to remain vigilant and communicate clearly. On fiscal policy, the constraints are real and they are tightening. Total public debt in the OECD reached 111% of GDP at the end of last year, up from 74% in 2007. Spending pressures from population aging, debt servicing and rising defence requirements are all pointed in the same direction. Stronger efforts to contain and reallocate spending, improve public sector efficiency and enhance revenues are essential, while preserving the growth potential on which debt reduction ultimately depends. In response to the energy shock, many OECD governments have introduced support measures for households and businesses. Our recommendation, targeted, temporary, with clear expiry mechanisms. Broad-based measures are fiscally costly and blunt the incentives to reduce energy use. Our analysis shows that of all energy support measures OECD countries have adopted in response to this conflict, a very high 55% have in fact been untargeted. At a time of constrained public finances, that level of inefficiency would seem unaffordable. Countries can reduce vulnerability to future energy shocks by diversifying their energy mix. Renewables accounted for just 6% of total energy supply across the OECD between 2019 and 2024. Nuclear energy, which accounted for only 9% of total OECD energy supply over the same period, down from 11% in the mid-1990s, is a vital tool for energy security, affordability and sustainability that deserves clear-eyed reassessment. Expanding nuclear capacity, including through small modular reactors, can provide reliable, low-emissions power that complements renewables and meets rising demand from digital technologies. Open markets and rules-based trade are among our most powerful tools for building resilience, and yet import restrictive measures are expanding rapidly. New restrictions introduced since 2009 now affect an estimated 19.7% of world imports, up from just 3.1% in 2016. That is a six-fold increase in less than a decade. New export restrictions in response to supply disruptions should be firmly avoided. They only exacerbate shortages. Constructive dialogue, making the trading system fairer and more resilient while preserving the benefits of openness, is the only durable answer. Finally, structural reform. Potential GDP per capita growth in the OECD is estimated at just 1.4% this year, down from around 2.2% back in the year 2000. The long-run productivity slowdown is the most important economic challenge most of our countries face, and it will not be solved just by managing the current shock. Our most consistent structural reform recommendations for countries: regulatory reform to lower entry barriers, reduce red tape and strengthen competition, and of course investment in skills through more effective education and lifelong learning systems. In closing, the energy shock from the Middle East conflict is real and serious. It is raising costs and uncertainty for households and businesses around the world. The tools to respond exist. Re-establishing secure energy supply routes, targeting support carefully, keeping monetary policy anchored to the data, putting public finances on a more sustainable path, diversifying energy sources, defending open markets, avoiding new export restrictions, and driving the structural reforms that determine long-run living standards. None of them are easy, all of them are necessary. So thank you very much, and I now hand over to our chief economist, Stefano, to talk to us, and then we will take your questions.
Thank you very much, Secretary General. Good morning to all of you. It's a great pleasure to contribute to the presentation of our economic outlook. I think I would like to start with one of the messages that the Secretary General just delivered. The evolving conflict in the Middle East has indeed become the main factor shaping the global economy. But I think it is important at the outset to recall that the world economy entered 2026 with pretty strong momentum. This was driven by strong investment, but also production of artificial intelligence, supporting financial conditions, and some easing of trade tensions. Since then, of course, the conflict has first and foremost brought a severe humanitarian cost, but also disruption in the shipping of energy and other essential inputs through the Strait of Hormuz, and damage to the energy infrastructure in the Gulf region. We do not know the extent of these damages, but probably will take time to repair them. These developments have led us to revise down our economic projections. We now expect a weaker economic growth, high inflation, and a more challenging economic environment. Let me shed some further light on our projection. Let me start actually with what I would consider a pretty benign scenario given the context. This is what we call the time-limited disruption scenario. Under this scenario, energy prices gradually fall in line with future markets, and energy production and trade in the Gulf economy progressively return to the pre-conflict level starting from the second half of 2026. Even in this scenario, you can see that growth actually slowed down significantly in 2026, and this actually affects both OECD and non-OECD economies. We move from 3.4% for the global economy to 2.8% in 2026, and in the OECD country from 1.8 to 1.5%. Now, under the assumption that energy price and fertilizer price will decline in the second half of 2026, we expect a little rebound in economic growth in 2027. We move to 3.1% for the global economy. Now, the Secretary General has already walked you through the tour of the globe, focused on the major economy. Let me present in this table the detailed projection for the G20 countries. I will not go into the individual country projection, but what I'd like you to do is to focus on the red bubble. These are where we have revised downward our projection by 3 or more, 0.3 percentage point compared to our December economic outlook. Now, what you can see in this slide is that for the G20 economies, in 2026, we have 8 economies where we revised down our projection by more than 0.3 percentage point, and we have 3 economies for which we have revised down the projection in 2027. This clearly underlines the significant impact of the energy price across the board. Now, when I move into the non-G20 OECD economies, here actually you see that there are 16 of the 26 countries shown in this chart. So 16 of the 26 non-G20 OECD economies, we have projected a significant downward revision in our economic projections. Why do we have more red bubble in this slide than the previous one? These are small and more open economies, and actually these economies are more sensitive to global energy supply shocks. There are also higher reliance on imported energy and more specialized economic structure. As a result, the global prices tend to feed more rapidly into domestic growth and into inflation. Now, the Secretary General pointed out that we have 2 scenarios precisely because there is so much uncertainty about the evolution of the conflict in the Middle East. So here it is actually the persistent disruption scenario. We definitely hope that this scenario will not materialize. But this assumption, this scenario assumes that actually energy price stay much higher for a much more prolonged period of time, well into 2027, and actually the disruption in energy production and export in the Gulf economies will persist well into 2027. Now, I think the numbers speak from themselves. In this case, and this is the purple bubble, the world economy will move from 3.4% growth in 2025 to 2.1% in 2026 and only 1.8% in 2027. Now, let's pause for a second about this 1.8% growth for the global economy. This is less than half of the average growth of the global economy in the past 25 years. So this is indeed a major slowdown in economic growth, and no question this will pose severe challenges for everybody, for consumers, for companies, and certainly will pose also severe challenges for policymakers to actually respond to these challenges. Now, all countries will be affected, but as you can see in this slide, the Asian economies will be particularly affected, especially in the prolonged disruption scenario. They are more exposed to basically energy product from the Gulf region. You can see that there is a significant further deceleration in economic growth. This is the difference with respect to the time-limited disruption scenario. At the same time, global inflation will increase further by 0.4 percentage point in 2026 and by 1.3 percentage point in 2027. There is no question that this will create very difficult macroeconomic trade-off, especially for monetary policy. So the Secretary General mentioned a number of the risks facing under both scenarios. I would like to focus on just a few of them, which are, in my view, also very important. So far, we have focused in particular on the impact of the energy crisis on inflation and on growth. But let me focus on one important additional measure, and these are the risks to affordable access to food in some of the low and middle-income countries. This chart illustrates the significant dependence of many developing and emerging economies on imported fertilizers. Actually, as you can see in the little dot at the top, they depend entirely on imported fertilizers. But what I'd like you to focus on in particular is actually on the red bar on this chart, because this points to the dependence of fertilizers coming from the Gulf region. And if you see the countries on the left-hand side, they depend significantly on imported fertilizers from the Gulf region. In countries like Sudan, the Central African Republic, Namibia, Mozambique, they depend in between 40 to 70 to 80% from imported fertilizers from the region. So limited access to fertilizers could reduce crop yield, and this can actually raise food insecurity, especially for the poorest and the most disadvantaged households in these countries. Another risk is what the Secretary General referred to, and this is related to trade tensions, but also I would like to say the uncertainty surrounding trade policy. This blue bar shows you are the evolution of U.S. effective tariffs, import tariffs, from December of 2024 to November of 2025. You see a significant increase, but also significant heterogeneity across countries. Now, if I look at the most recent evolution from December of 2025 to the most recent data, you can see that there's been some reduction in tariff rates. And also, if you look at the green little dot, shows that there is less differences across countries. Since then, indeed, the US tariffs have been lowered significantly across countries. However, additional trade measures, including temporary broad-based tariff and sector-specific restrictions, continue to weigh on global trade flows and also on investment decisions. Let me say that the uncertainty matters in its own right. When future trade conditions remain unclear, firms tend to reduce their decision on investment, on hiring, and this actually can be particularly important in capital-intensive sectors and in highly integrated global supply chain. Let me focus on one possible upside risk, and this is linked to the rapid advance in artificial intelligence technology and actually the strong optimism that surrounds them. As you can see on the left-hand side chart in this, there is no sign of momentum fading. If we look at the planned investment by major AI companies, both for 26 and for 2027, this is expected to almost double the level of 25. So this is a significant, strong investment in artificial intelligence. There is a lot of uncertainty, but the potential gains are also large. According to the OECD estimate, which you see on the right-hand side panel here, a broad adoption of artificial intelligence combined with complementary investment in traditional software would actually raise annual GDP per capita growth on average in the G20 economies by some 0.4 percentage point. And if you look at the country on the right-hand side, in countries like the United Kingdom or the United States, this can go as high as 0.9 percentage point. If this benefit were to materialize, AI investment and the associated impact on productivity would definitely represent an upside risk to the outlook. However, this benefit cannot be taken for granted. The Secretary General referred to that. Of course, the energy crisis we are living in will raise the operating cost of data centers. 60% of the operating cost of data center depend on energy, can constrain the supply of critical hardware, including microchips, and actually can amplify the financial risk if growing debt-financed AI investment fail to deliver on the expected returns. So far, we have been talking about the different challenges facing the economic outlook. Let me now focus on the key policies. First of all, I think focusing on monetary policy, there is simply no questions that central banks are facing a very difficult balancing act. They need to contain inflation risk while avoiding at the same time unnecessary sharp slowdown in economic growth. In principle, central bank can look through a temporary increase in headline inflation, which is brought by higher energy and food prices. This, I think, will be more consistent with our time-limited disruption scenario. As it is shown in this slide, indeed, the short-term inflation expectations have increased, reflecting the increase in energy and food prices. However, if we look at longer-term expectations, they tend to remain broadly stable. This suggests that market and households, for the time being, are expecting inflation to return to our target over time. Nevertheless, of course, the central bank may have to intervene, especially if energy price pressure proves to be more persistent, and there are signs of spillover more broadly into underlying inflation. Now, the Secretary General highlighted that this fiscal space is actually limited in many countries, and the very strong importance of ensuring continuous progress towards fiscal sustainability. In response to the energy crisis, government actually acted pretty swiftly, roll out a range of measures to support both households and firms. You see the measures that we have collected through our energy support measure tracker. But perhaps in this context, it's important to recall some of the lessons we have learned from previous energy crises. The famous 3T. Measures have to be timely, measures have to be targeted, and measures have to be temporary. So certainly, measures have been very timely. Countries have rolled out a number of measures across the board, but so far, most of the measures have focused on reducing energy prices, either directly through tax systems or subsidies. They are faster to roll out, and certainly they are much more visible. The problem is actually the second T, so the targeted measures. And you can see in this slide that actually most of the measures that countries have introduced have not been targeted. So why targeting is so important? It is important because we know very well that low-income households are more affected by a hike in energy prices. They spend a larger proportion of their income of energy. Rural households actually might have less means to adjust, for example, their transport patterns, and small and medium-sized enterprises may face less liquidity to adjust to the higher energy bill. So well-targeted measures can protect really the most vulnerable groups and firms, and at the same time at a lower fiscal cost. The other key lessons we have learned from previous energy crises is also to ensure that support measures are temporary. So as soon as energy prices tend to normalize, they have to be withdrawn. But let me add actually a fourth T, which is transformative. We need to make sure that the short-term measure to support households and firms actually preserve incentive for energy efficiency and for diversification. In this context, price signals actually do matter very much. Measures such as tax reduction, subsidized price, regulatory price cap, and export restrictions, so all the measures you find on the left-hand side of this chart, basically do not really encourage energy saving, do not reduce consumption of energy at a time in which we need that because this is an energy supply shock. But actually preserving price signals can actually reduce the dependence on fossil fuel And this is very important because we have to make sure that short-term measures actually strengthen rather than delay the longer-term resilience effort that many countries around the world are actually undertaking. So let me conclude with some key messages emerging from our economic outlook. First, the conflict in the Middle East has become indeed the dominant force shaping the global economy. We now expect a weaker global growth, high uncertainty, and certainly a much more challenging economic environment. The longer the disruption lasts, the greater the economic but also the social cost of this crisis, and certainly will make policy choices much more difficult and hard. These are the main messages I would like to convey with you, and I thank you very much for your attention. Thanks.
Stefano, thank you very much. We will enter into the question and answer part of the session. Invite the Secretary General back on stage. We'll be taking questions from journalists here in the room, but also those on Zoom. If you feel like putting your questions into the Zoom, we'll try to get to as many as we can. We'll start with those here in the room. Right here, I see. Go ahead.
Good morning, William Hurban from Bloomberg, to your right. The US this morning has announced 10% tariffs across the board. How does this announcement impact your assessment of the economic outlook? And a second question about your prolonged disruption scenario, monetary policy. Could you expand a bit on how you expect central banks to react in that situation and the risks of policy errors?
Well, on the tariff rate, these are not included in our projection. Of course, it would have an impact on economic growth. On the second question that you asked, the prolonged disruption scenario is a model-based simulation. Again, as I said, we assume that energy price will stay much, much higher for a much more prolonged period of time, and also the disruption in energy production in the Gulf region will continue. There is no question that while monetary policy can lock through the temporary increase in headline inflation in the time-limited disruption scenario, if we move into a prolonged disruption scenario, monetary policy would have to probably intervene by raising interest rate. Of course, we will face a very difficult balance on the one hand to secure that inflation expectation remain well anchored on the one hand, but on the other hand, also try not to sort of affect economic growth too. So obviously, they will facing the degree of challenges that the monetary policy and actually fiscal policy will be facing will increase as we move from the time-limited scenario into the prolonged disruption scenario.
I see another question over here.
Ángel Calvo from the Spanish press news agency EFE. In the previous reports, you have repeatedly said that in the case of Spain, migration has been one of the main contributors to growth. Now there's regularization, perhaps 500,000 or even more people are going to be regularized. And so what will be the impact of this event if you have evaluated it?
Well, certainly we have taken into account the different policies that the Spanish government has put in place. In Spain, we are moving from 2.8% growth to 2.2% growth in 2026 under the time-limited disruption scenario. I think one of the drivers of the solid growth in Spain has also been a strong labor market, and I think there's been a long-standing policy for actually regularization of migrants. So, of course, this has been one factor sustaining also the Spanish economy. One important point to mention here is not just the regularization of migrants, but to make sure that they are fully integrated into the labor market. So you need policies actually to promote their full access into the labor market so that they can really give the kind of contribution they can to the economy in Spain. So Spain is actually a good interesting case also because of the diversification of energy and rely less on fossil fuel, and this is one of the factors that actually has led the Spanish economies to basically withstand this energy crisis perhaps better than other European countries.
I see another question right over here.
Hello, Martin Powers from AFP News Agency. In your worst-case scenario, what are the countries that are more likely to enter a recession, according to you? Thank you.
Well, I think, as we've said, basically the Asian economies are more exposed, but I think there is a significant difference also within this region. There are some countries in the Asia region that actually have larger strategic reserves, so they can withstand even a prolonged period of high energy prices better. Other countries in the Asian region actually have less reserves, and for them, of course, a prolonged disruption scenario will be certainly much more painful. Small and open economies tend to be more affected by a prolonged slowdown in economic activity. But if you talk about recession, of course, we have to look at those countries where already start, even in the time-limited disruption scenario, from relatively low economic growth, and these affect, for example, a number of European countries that have a slow growth also in the more benign scenario, again, the time-limited disruption scenario.
I'm looking if there are other questions here from the media. If not, we have one from the journalist watching us online. Paolo Levi from this Italian agency ANSA asks, what are your principal suggestions for Italy?
Well, of course, Italy is facing a number of challenges. You see in our projections that in Italy growth will be 0.5% in 2025, and then will go up slightly to 0.6%. I think the full implementation of the Resilience and Recovery Plan is an important objective for Italy. I think maintaining the process toward fiscal consolidation is also very important, but also I think, as the Secretary General said, there are a number of important structural reforms that will be important for Italy, improve the business environment, allow new firms to enter the market. Italy has an interesting situation because you have a very highly productive medium to large firms. Actually, they're even more productive than those in other European countries, but has many, many firms with very small firms with less than 20 employees that actually have very low productivity level. So supporting them, for example, into the transition by using artificial intelligence is certainly an important challenge that Italy is facing. And I think all countries, not only Italy, can certainly benefit by greater use of artificial intelligence, not only in the private sector, but actually in the public sector. There is significant improvement in the efficiency of public sector by using properly artificial intelligence and in particular generative AI.
Looking one more time if there are any other questions here from the media in the room. I see one final question right there, please.
Bonjour, Monsieur Wamossi d'Obaï TV. J'ai une petite question concernant la crise de droits d'hormone. Vous avez parlé une partie très importante dans votre rapport sur ce sujet. Il faut combien de temps pour sortir de cette crise? Et en cas de prolongation de fermeture, est-ce que l'OCDE dispose des scénarios pour faire face à cette crise mondiale? Merci.
Well, we do not know exactly, when the conflict in the Middle East will be sorted out. The reason why we have actually not a baseline and then different scenario analysis, but we have two scenarios, is precisely because of the very high uncertainty surrounding a lasting resolution of the conflict in the Middle East. I think the Strait of Hormuz is a fundamental choke point. I think this has been mentioned. It's not just for oil and gas. It's about fertilizer. It's about a number of fundamental industrial input. This is why we presented the prolonged disruption scenario, in which we assume that the Strait of Hormuz will remain closed for a period of time. And this, of course, as we've been discussing, the Secretary General and I, will have a very dear economic consequence, but also social consequences. We all hope that there will be sort of a lasting resolution of the conflict in the Middle East soon, and that we can move from the prolonged disruption scenario more into time-limited disruption scenario. I think this is the hope of everyone. But I think the important point of this outlook is also to prepare in case this crisis will actually continue and actually think about what kind of policy responses have to be put in place. These will be difficult choices that government would have to make to actually support consumers, to support firms, and to actually to weather what could be a very severe crisis.
Thank you. Stefano, Secretary General, thank you very much. We're going to close this press conference now. All the information on the economic outlook is on the OECD website. Thank you very much.